All right, we're looking at the Julian Alvarez case study. Let's scroll down and read the first question. Question 1. What is the most accurate point Smith made about Radisson's pension plan? Only point 1, only point 2, or both points 1 and 2. So we're going to have these 2 points and need to figure out which or if both are accurate. Julian Alvarez manages portfolios for Kempinski Investments, an asset management company. He enlists the assistance of Harry Smith, a junior analyst, to prepare for meetings with 2 of Kempinski's clients. First on the agenda is a meeting with Radisson Incorporated, a rapidly growing Canadian technology firm with a young employee base and a high workforce turnover rate. Radisson's pension plan is based on a defined benefit plan, which Alvarez directs Smith to review in detail. A total of $28 million in assets is under management for the plan and overfunded. As a result of Smith's observations, the following 2 points can be made. Point 1. So these are the 2 points that are in question for our question. The overfunded status of Radisson's pension plan benefits its shareholders. So this is going to be, yes, an accurate statement. If a pension plan is overfunded, it's going to show as an asset on the balance sheet. And this is also just going to mean that the company won't need to use as much cash in the future to put towards contributions. So they can use that cash to put towards contributions into the plan. So that cash can be used to return capital to shareholders in the form of dividends or buybacks, or they can reinvest back in the business, kind of do whatever. So good for the balance sheet and also just good for the business's cash flow if they're not needing to contribute as much. Point 2, Radisson's funded ratio will decrease if employee turnover decreases. So if employee turnover decreases, that means that employees are staying for a longer tenure, which is obviously a good thing for a business. But from a pension plan standpoint, increased tenure is going to lead to an increase in the obligation for future pension payouts for those employees. And so basically, if employees are staying longer, this will cause the funded ratio to decrease. So the company will have to either have greater investment returns or contribute more cash to kind of keep up with that. So this point is also good. So we're going to go with the answer that says points 1 and 2 are both good. What is most accurate about the pension plan? Points 1 and 2. Answer C. Question 2. It is best to characterize the investment sophistication of Radisson's pension plan as average, below average, or above average. We left off right here, so we'll start reading. Kempinski Investments manages Radisson's pension plan exclusively. Based on Radisson's fee structure, Kempinski will be compensated at a high base rate regardless of their performance. Smith explains to Alvarez that outsourcing offers the following 3 benefits to small institutional investors, such as Radisson's pension plan. Benefit 1 reduces regulatory requirements. Benefit 2 facilitates handling of principal agent issues in a way that eliminates conflict of interest. Or benefit 3 grants investors access to various investment strategies due to scale advantages. During a meeting with Radisson, Alvarez described Kempinski's investment approach. Okay, now this might be something that we're looking at. In managing the pension asset plan as a part of their investment strategy, alternative assets are heavily allocated to the approach. Active management is prominent, and assets are outsourced to external asset managers. Radisson's investment strategy is also affected by the fact that the pension fund's assets represent a small portion of Radisson's market cap. This prompts Alvarez to explain that Radisson's operating results correlate poorly with the pension asset returns. Okay, so we're looking at sophistication of Radisson's asset, Radisson's plan, and let's see here. So the Radisson is a client of Kempinski, as a reminder back up here. So we're looking at Kempinski's investment approach and how that's kind of applied to Radisson. So basically what they're describing here, a lot of alternative investments, active management, and outsourcing to external managers, that's going to be the endowment model, which typically involves a lot of alts and heavy manager due diligence. So this is usually going to require a lot of heavy lifting from the investment staff and a lot of sophistication. So when we're looking at kind of average, below average, above average, kind of as a comparison, we might say below average is something like the Norway model, where they're using a lot of index funds or just kind of owning the market. And then above average would be kind of the endowment model, where we're getting to the high end of sophistication there with the alts and due diligence needed there. And then average would probably just be somewhere in between those two. So we'll go with answer C, above average investment sophistication. Question 3. Which of the following statements is the most accurate based on Alvarez's statement regarding ERISA and ASC 715? Radisson cannot terminate the plan. Radisson's balance sheet must include Radisson's plan as an asset. Or C, Radisson can exclude the service costs associated with the plan from net income. So we left off right here with correlate poorly with pension asset returns. In his analysis, Alvarez states that the plan is subject to the entire Employee Retirement Income Security Act of 1974, ERISA, and is governed by generally accepted accounting principles, including accounting standards, codification, ASC 715, compensation retirement benefits. In his second meeting, okay, so it looks like we've got what we need. There's not really any information in the reading here. We're kind of just, what can they do? Can they do these three things based on ERISA and ASC 715? So A, Radisson cannot terminate the plan. That is incorrect. Under ERISA, they would be able to terminate the plan. B, Radisson's balance sheet must include Radisson's plan as an asset. That is true. And in this case, it is an asset because they're overfunded. I think they mentioned up above. Yeah, they're overfunded, so it is an asset. If it was underfunded, then they'd be required to hold it or put it on the balance sheet as a liability. And then C, Radisson can exclude the service costs associated with the plan from net income. They have to include the service costs under net income. Pensions are a part of the company's financials, so we're going to have to show stuff on the balance sheet, and the income statement can't exclude it. So we'll go with B. Question 4. Based on the characteristics of the fund, which of the proposed allocations in Exhibit 1 is the most appropriate? Allocation X, allocation Y, or allocation Z? So I think we left off here, so we'll read basically till the bottom. In his second meeting, Alvarez meets William Bronny, the chief investment officer of the Pack University Endowment Fund, the fund. Bronny has hired Kempinski to assist him in developing a new investment policy that would be presented to the fund's board of directors for their approval. Aiming to maintain long-term purchasing power, that's going to be important for where we want to allocate. While providing financial support to Pack University, the fund has assets worth $350 million under its management. During the meeting, Bronny revealed that the fund pays Pack University 4% of its 3-year rolling asset value. So that's going to be important for our return target for this fund, or for the endowment. And that its risk tolerance should take the following 3 liability traits into account. Debt markets are easily accessible to the fund. There is a 10% contribution from the fund to the Pacific University annual budget. Gifts and donations contribute significantly to the fund's annual inflow. The fund's investment approach is based on the Norway model. So as we talked about earlier, Norway model is going to be a lot simpler and use more of a own the market approach. And its investment staff has limited experience managing alternative investments. By allocating to hedge funds and private equity, Alvarez suggests a change in the investment approach. Exhibit 1 presents nominal expected returns for various asset classes and 3 proposed allocations that include some allocations to alternative assets. So we've got allocation X, Y, and Z, and the different allocations and our expected returns for each of these different asset classes. So based on the characteristics of the fund, where should we be allocating? So there's a lot of moving variables here. And then last thing here, annual inflation rate is going to be 2.5% over the next 10 years, assumed. So a lot going on here, which is why it's good to highlight as we go through. So we need to maintain long-term purchasing power. and we have a 4% spend rate with 2.5% inflation. So that right there is creating a return hurdle rate of 2.5 plus 4%, so 6.5%. We need to earn over 6.5% just to kind of keep our long-term purchasing power. And then the second variable here, we've got Norway model, limited staff experience. So we've got hedge funds and private equity allocations down here. And even though these have good expected returns, we need to be mindful of these allocation numbers. If we have limited experience here, we probably don't want to have 60% of the portfolio from allocation Y in something where the staff has limited experience. So first step here is to kind of just calculate the expected return. So I've already got these, got this down here. So allocation X expected return is going to be 5.81%. So right away, we're going to be able to go ahead and rule out allocation X. Our hurdle, as we said before, was going to be 6.5. So 5.8 doesn't meet that. So we can rule out X right away, even though it looks best from the Norway model perspective, and having limited experience on alts, we're going to have to dip more into the alts to kind of meet our return target. All right, and then for Y, we have expected return of 9.06%, and then for Z, we have 9.92%. So both of these meet the hurdle target, and this is where this question gets a little tricky, but this is where we want to take into account the staff's limited alts experience. So for, and I guess it doesn't necessarily matter that much. So for Y and Z, Z has the highest return, and it also has less alts exposure relative to Y. So that's going to be the better choice. They both beat the hurdle, but Z is going to have less alts and meet our return hurdle. So we'll go with C, allocation Z.